Hi folks, and welcome back to our Diluted EPS video series. In this series we're going to look at some problems where convertible bonds, convertible preferred shares, or even options perhaps have been actually converted into common shares. In this case we're going to look solely at preferred shares, but again the problem that we're going to do is listed in your online course, so make sure that you have access to it there. Now again, as I said, we've assumed so far that none of the convertible securities, none of them were actually converted during the year, but that's not always the case. In our particular question, we have four types of securities. We have preferred shares that are convertible, convertible debentures. Debentures are a type of bond. And then we have options of two types, where the exercise price is $14 a share and where the exercise price is $22 a share. So what we need to do is we need to look at all four of these securities to see whether or not they should be included in the diluted EPS calculation. But because they're converted, we have an extra rule that we need to abide by. And the rule is that when there are conversions during the year of any securities, whether they be options, bonds, or preferred shares, we use what your textbook refers to as the backdating concept, meaning that we treat the security that we're looking at as if or what if it had been converted at the earliest possible date this year. So in other words, even though it might have been converted, say, on April the 1st of any given year, so say we had preferred shares that were converted into common in April and they existed in January, our diluted EPS would look at an increase in the earnings available to common shares by saying, what if these preferred shares that were converted April the 1st were actually converted at the beginning of the year? Okay, 3 months earlier. So the concept is the same as we've always been doing when we assumed no conversions, but now we only have to convert part way back to the beginning of the year because the conversions actually took place. So now, with that little piece of theory in mind, let's see if we can go through and do our question using the same three steps that we've always used. The first thing we're going to do is calculate the basic EPS. So you can see from your question that the company's net earnings for the year were $2,289,000. But now don't forget, there were actually some conversion of preferred shares that took place during the year. And in fact, it says here that the preferred shares were converted on July 1st, 2000 at 6. There were 150,000 of those preferred shares that were converted. Now, note one thing. Note that it says here as well that at the end of the year, so if you go to the top of the equity section of your question, note that it says here that at the end of the year, December 31st, 2000 x 6, we now have 350,000 cumulative preferred shares that are convertible outstanding. In our question, it says that 150,000 preferred shares on July 1st were converted. So that must mean that we had 500,000 before conversion, right? So we wound up with 350,000 at the end of the year. That's in the question, right? The first bullet tells you that 150,000 were converted on July 1st. So if you're left with 350,000, it means before conversion you must have had 500,000, of which 150,000 were converted, so therefore 350,000 are left. So you need to read these questions carefully to make sure that just to make sure that you can see what dates you're working at and know how many shares are available at what date. So in this case, what I'm going to do now, because these preferred shares, some of them were converted, I need to figure out what amount in preferred shares were actually declared. And don't forget, they're cumulative, right? So we have to deduct them from our earnings, $2.289 million, in order to see how much is available to common. So now in this case, I know that I had 350,000 of them outstanding for only 2 quarters, right? And those 2 quarters would have been the last 2 quarters, because 150,000 of the original 500,000 got converted on July 1st. So from July 1st, after the conversion to the end of the year, there's 2 quarters in there. So I would have owed $175,000 to those preferred shareholders after the conversion based on these $350,000, right? But now I know that pre-conversion, I would have owed my preferred shareholders, again, because we have cumulative preferred shares, right? I know that I would have owed them on 500,000 shares 25 cents a quarter. And that would have been for the first 2 quarters, right? So in other words, you know that for the first 2 quarters of the year, you had 500,000 preferred shares outstanding. And now by the time you get to the end of the year, you only have 350,000 outstanding because you converted 150,000, right? So therefore, I have to look at how much were my preferred shareholders entitled to. All right. So now what I need to do is I need to take that information into account to calculate my WACC, because I can see now that when I do the math here, I'm going to wind up with earnings available to common after I satisfy the needs of my shareholders that remain, okay, as preferred shareholders, right, at the end of the 2 quarters, and fulfill the needs of the preferred shareholders that existed pre-conversion date, $250,000. The basic earnings, the earnings available to common shareholders for our basic EPS calculation would be $1,864,000. But don't forget, because we now have some more common shares out there as a result of the conversion, that's also going to affect my WACC calculation for my basic EPS. So let's have a look at that. So now, what do I know? I know from the question that it told me in the equity section I have 3.5 million common shares outstanding at the end of 2006. So that 3.5 million already includes any of the common shares that were issued as a result of the preferred share exchange, right? So again, I know that I converted 150,000 preferred shares to common, right? And don't forget, those preferred shares that were converted into common, each preferred share gets 4 common, right? So now, as a result of that, I now have 600,000 more preferred shares out there, which are part of this 3.5 million, right? But those extra 600,000, which are part of this 3.5 million, were only outstanding for the last 6 months of the year, from July 1st to the end of December, right? So before those 600,000 shares were issued as a result of the preferred share conversion, I must have only had 2.9 million outstanding, right? 600,000 less than I now have as at July 1st to the end of December, right? So therefore, those 2.9 million were outstanding for the first 6 months of the year. So when I do a WACC calculation here, I'm going to get my WACC on average for the year was 3.2 million to give me a basic EPS of 58 cents a share. So now what I need to do is I need to test each security to see if it's dilutive, or to see if I'm going to include it in the diluted EPS calculation. But before we do, I know this is a new section for many of you now that we've got conversions. You may want to replay this section of the video in order to make sure that you have a firm grasp on how actual conversions impact your basic EPS calculation, because they do. Right? So it impacts your basic as well as your diluted EPS calculation. So make sure you're comfortable with that before we move on and get to our diluted EPS, our testing to see if securities are going to be in the diluted EPS calculation. Now, once you've done that, let's now go back to what we would say is our original step 2, which is now we're going to test each security to see if it's going to be included in the diluted EPS calculation. So now, in the question, we have 2 kinds of options. We have $14 options, the exercise price being $14, and we also have $22 options. Now, the question tells you that the average market price for the period was $18 a share. So now we can see here that the exercise price is less than the market price, so therefore we know that the options are dilutive. The only thing we want to make sure we do while we're here is we need to figure out now how many more shares will we have issued as a company in order to fulfill those stock options had they been converted or had they been exercised and common shares been issued. Note that in this case, the options were not exercised. Neither of the options were exercised. The only actual conversions we had here were with preferred shares. But we still have to use the treasury stock method for these $14 options because we know that they are dilutive because they're in the money or there is intrinsic value, right? So now, we already know from previous videos that the issuance of shares, had these options been exercised, has no impact on the numerator, but it does in the denominator because we're going to have to issue more shares in order to fulfill the what if scenario had the options been converted. So how are we going to figure that out? Well, as we said before in our first video, we're going to use the treasury stock method, which assumes that the company is going to use the money that their shareholders would have given them, go out into the marketplace, and buy up the shares at the market price in order to fulfill some of the requirement for the stock options, right? So now what they would do is they would have to issue additional shares under the what if scenario, assuming these guys would have converted their options to shares. So now let's see how many new shares would have been issued. Well, again, we know the exercise price was $14 a share, and these guys would have received $600,000 or 600,000 common shares, right? So the 600,000 common shares that they would have received when they exercised their options would mean that they would have given us $8.4 million. We would have taken that $8.4 million and based on the treasury stock method, we would have gone into the open market and tried to buy back some shares at the market price, which we're told is $18 a share. So ignoring fractional shares, we would have bought back 466,667 shares in order to issue 600,000. So we would have still had to issue 133,333 shares. Okay? Now, we're going to come back to this when we're doing our diluted EPS calculation. Right? So let's now move on to the next set of options, and you can do your dilution test in any order you want. You don't have to do options first, but you do have to make sure that you test everything for dilution. Now, the $22 options are anti-dilutive because they're underwater. So in other words, the exercise price is greater than the $18 market price. So therefore, these options we refer to as being underwater, i.e. not in the money. They have no intrinsic value. So therefore, they're anti-dilutive, and we're going to exclude them from our diluted EPS calculation. So now, let's have a look at the convertible debentures, which we know are bonds. Our aim here is going to be to determine if the bonds were converted, would they have been included in the diluted EPS calculation. So let's remember what we learned in a previous video and see if we can now take this concept and apply it to bonds. Again, the bonds weren't converted, so it's a truly what-if scenario. We have no actual conversions. So if the bonds were converted, let's have a look at the EPS impact that it would have had. Well, in the numerator of your EPS calculation, your net income would increase if we converted the bonds because we wouldn't have any interest expense booked on them. And don't forget, because our net income or our earnings available to common is based on net income, we're looking to calculate the after-tax interest expense that would have been avoided. So we need to calculate the amount of interest expense not booked after tax to see the impact on EPS. So we're looking at the interest. I should probably, just to be clear, say interest expense avoided after tax, and we're going to divide that by, if these bonds had been converted to common, what would our change in WACC have been? So your question actually calculated this for you. They gave you $175,000 in interest expense that would have been saved, but that's pre-tax. You have to calculate it after tax. In the question, they give you a 48% rate. So now we know that our income available to common shareholders would have increased by $91,000 had we not booked any interest expense on the bonds if they had been converted. So now, what do we have to do in the denominator? Well, to figure out what the change in WACC would have been in the denominator, we have to figure out how many more shares would have been issued. How many more shares would have been issued, all right, if we had converted those 4 million in bonds? So we had 4 million in bonds, and in your question it tells you that they're in denominations of $100, right? So you would have 40,000 bonds, each of which is convertible into 12 shares. So that would give you 480,000 new shares on the market had they been converted. So therefore, your EPS impact as a result of the bonds would be $19 a share. 19 cents a share, which is less than 58, so I'm going to include it in my diluted EPS calculation. All right. Now, let's look at the preferred shares. Some were converted and some were not. I'm going to look at the ones that were not converted first. That's the amount that we have left at the end of the year, which is $350,000. So now, how am I going to incorporate the fact that these preferred shares were not converted, all right, into my diluted EPS test? So first thing I'm going to do is I'm going to say, well, what if these preferred shares that are now outstanding at the end of the year had been converted? Well, don't forget, these 350,000 shares don't include the 150,000 that were converted. Why? They're separate. Remember, we did a discussion earlier and we said that we must have had 500,000 preferred shares at the beginning of the year, such that when 150,000 are converted, we have 350,000 at the end. So the calculation now looks very similar to the no conversions for this amount of shares to say what's the dollar value of the dividends I would have avoided had I converted the preferreds to common, and how many more shares would I have had outstanding. So now the question tells you that those 350,000 preferred shares that are sitting in your balance sheet at the end of the year have a dividend of $1 a share. That's an annual dividend. So I would have avoided 350,000 in dividend payments. And if I had converted all those 350,000 preferreds, I would have had each preferred exchanged for 4 common. So I would have now had 1.4 million common out there, which means I would have had an EPS impact of 25 cents a share, which is less than your basic of 58 cents. So I'm going to include this in the diluted EPS calculation. Now I want to have a look at the preferred shares that I converted. So we look at all of them. All right. Now, if we had converted those 150,000 shares that we converted on July 1st, what would have been the impact if I had converted them at the earliest available opportunity, which in this case would have been January 1st? I would have avoided dividends of 25 cents a quarter for the first 2 quarters. That's the quarter from January 1st to March 30th and April 1st to June 30th, right? Those are your 2 quarters. So now I would have avoided dividends of $75,000, and I would have had issued an additional 150,000 times 4, because don't forget, the 150 shares are each convertible into 4 common. So I would have had 600,000, that should actually be 300,000, right? 300,000 more shares available, right? Because they would have been available 6 months earlier. So see how the proration enters into this, right? Because I would have had those 600,000 common shares available 6 months earlier. So therefore, I would have had a WACC impact of 300,000, which means I'm going to have an impact here of 25 cents a share, which again is less than 58 cents. So I'm going to include it in the diluted EPS calculation. But don't forget, Now I'm into step 3, and I'm now looking at the diluted EPS calculation. If you need a break to review this section here where we've done step 2, now would be a good time to do that. All right. For the rest of you, I'm going to move on, and we're going to look at step 3, calculating diluted EPS. So now what's going to happen here? Well, I'm just copying down our basic EPS calculation from above. And now don't forget, when I'm doing my diluted EPS calculation, I go from most to least dilutive. I now know that my options that I included in the calculation, if you go back here, I said these options are dilutive. The $22 options were not. So I need to go back and make sure that my WACC is going to be increased by this number of shares in my diluted EPS cascade worksheet. So there I have the number of shares that are going to be issued. Subtract from that the number I'd repurchase to give me an additional 133,333, which when added to this will give me 3,333,333 weighted average common shares. Remember, we said options have no effect on the numerator. They have no EPS impact. So now I've got a subtotal of 56 cents a share, which I'm okay with because it is less than my EPS, right? My basic. So I'm good. Now I'm going to look at the debentures. Why? Because you remember that the EPS impact there was 19 cents a share, which is less than the 25 cents on the preferreds. So now if I do a subtotal and include their impact in here, I'm going to get 1,955,000 as my earnings available to common if those bonds had been converted. And I would have also issued 480,000 more shares. Again, we did that up here when we looked at the bonds, right? Up here, right? We would have said 480,000 more shares are out there, right? So now we would have a subtotal of 3,813,333 shares, which is now going to give me a subtotal of 51 cents a share, dividing our cumulative earnings available under the if converted method, dividing that by our WACs, number of common shares that would have been outstanding if those options and if those debentures or bonds had been converted. So now let's look at the subtotal for the preferred shares. These guys are the least dilutive because they have an impact of 25 cents a share, right? So now, if they were unconverted, or the 350,000 that were not converted, we said that we would have had available 350,000 more dollars. Why? Because don't forget, on those 350,000 shares that are sitting in your balance sheet at the end of December, they would have been paid a $1 per share dividend. If they had been converted, we wouldn't have paid that. So that would have been an extra 350,000 or 350,000 preferreds times $1 per share, okay, available to the common shareholders, which means cumulatively they would have had this plus this, which would have given them access to 2.305 million, right? Now, if we had converted those 350,000 shares at the beginning of the year, we would have had 350,000 preferreds times 4 because they would have been converted each into 4 common shares. So we would have had 1.4 million common. So we would have had, all told, a WACs of 5,213,000. Whoops, should be 333 here. Okay. If we had converted those preferred shares, which if we divide our earnings available to common divided by our WACs, if we had converted, we would have a diluted EPS of 44 cents. But now we have to go back to those preferred shares that we converted. Don't forget them. If we had converted them 6 months earlier, what we said is that we would have avoided dividends 2 months earlier or 2 quarters earlier, right? Because we converted them July 1st, all we're saying is, what if we had converted them two quarters earlier? We would have saved $75,000, right, in dividends to preferreds that would have been available to common, and we said we would have had 600,000 common shares available 6 months earlier. So prorated would have been 300,000 available under a weighted average calculation, right, which would have been 300,000. So now if we do a diluted EPS calculation, we see that our diluted EPS would have been based on earnings available to common of 2.38 million, and our WACs would have been, if we had backdated that or if they had been converted earlier, 5,513,333, and that would have given us a diluted EPS which is slightly smaller at 43 cents a share. So on your statement of comprehensive income, what would you show? You'd show basic EPS of 58 cents a share and diluted EPS of what we got here, which is 43 cents a share. So this now concludes our video on calculating a diluted EPS based on actual conversions of preferred shares during the period.